all the top headlines that we are tracking from the world of commodities, but the big story of the day is the kind of moves that we are seeing in the oil market after OPEC Plus outcome yesterday. Brent is sitting with a cut of nearly 0.5% as we speak to trade near that $69.3 per barrel mark. Remember, this is the third consecutive day of decline that we are seeing for the oil market after a jump up of nearly 1.8% that we saw last week. Now, remember, this is also the third consecutive month of spike up that we have seen in the oil market. Brent crude rose near 1% jump in the month of June and 7% jump that we saw in the month of July. Now, OPEC Plus, largely on expected lines, has again hiked its output for the month of September by 5,48,000 barrels per day. And the group aims to reclaim its lost market share, and that is the reason OPEC Plus continues to increase its output for the fifth straight month. Now remember, this is a part of larger scheme of things. OPEC Plus group had announced output cut to the tune of 2.2 million barrels per day in the month of May 2023. And now, with this output hike that has been announced for the month of September, OPEC will complete supply revival plan a year earlier. Remember, this unwinding was likely to be completed in September 2026, and now it is likely to be completed in the month of September in 2025 itself. So that's the kind of OPEC Plus output hike that has been announced over the last several months. Now, Goldman Sachs has come out with a report where they are saying that OPEC Plus is likely to keep output unchanged after the September hike that was announced yesterday, and they are maintaining their forecast. So, for the fourth quarter of calendar year 2025, Goldman Sachs expects Brent to average near that $64 per barrel mark, and it could average near $56 per barrel mark in calendar year 2026. So that's as far as oil market is concerned and the news surrounding it. But what's the outlook going forward? To discuss exactly this, we are now joined by Mr. Kunal Shah, Head of Commodities Research at Nirmal. Mr. Shah, thank you so much for taking your time out and joining us here on ET Now. OPEC Plus outcome has been largely on expected lines, isn't it? What is your take on 5,50,000 barrels per day output hike that has been announced yet again for the month of September, and now the entire unwinding has been completed 1 year ahead of their guidance?
Yeah, so I believe that OPEC output hike is a first signal that the willingness that OPEC is showing towards raising its supply, even though the demand continues to remain strong, but I think in line with the kind of excess capacity they have and the need going forward during winter season is also approaching. So this is very healthy for the market. It doesn't mean that the markets are going to crash. The number is not a staggering number. It's not a number which will lead to a collapse in oil prices. So the rationalization of oil prices have already taken place. Brent have come down from $75 to almost below $70 right now. I'm not expecting a sharp crash or anything like that. The index is weakening, and the ongoing geopolitical concerns between US and Russia will continue to support oil going forward. So we believe that 57.80, 5800 are good. Those levels are a good range to initiate long position for the upside target of potentially 5980 or 6,000 rupees. So on WTI can go up by another $1.5 $2 from here, considering the weakness in dollar and geopolitical concerns. So we are recommending to buy this dip rather than going short.
But buy the dip, that's the word coming in, and you're not expecting oil prices to fall substantially from the current level, and that 5,50,000 output hike is not a big number and also largely in line with what the street was working with. But Mr. Shah, another issue that the world is facing is the purchase of oil that is being done by countries like India from Russia. And that was precisely the reason why oil shot up to nearly $73, $74 last week. What's your stance and what is your view on the purchase of oil that is being done from Russia? There are several reports which suggest that perhaps that could stop going forward. What does this mean for the global oil market then?
Okay, so first of all, China and India both have expressed that they are likely to continue their purchase of oil from Russia. And considering the energy security of their country, they are likely to do the same. So if they say what if they do what they say, then I think it's not going to have any significant impact. But if they continue, India or China decides not to buy oil from Russia, then it will lead to a sharp upside in oil futures because let us say if India is not importing 1.5 million barrels of oil from Russia, and China is not importing, say for example, 3 million barrels of oil from Russia. So in that scenario, India and China cumulatively will go towards the other producers which are not able to give the result, which are not able to produce the same amount of oil. So I think in that scenario, oil prices can really shoot up quite sharply. So let us keep our fingers crossed that that kind of scenario doesn't happen. If it does happen, then it's a big problem for oil.
Okay, so that could be a big problem for the oil. As of now, of course, we don't have any confirmation from the government on what the outlook and what the way forward could be for oil marketing companies back home in India. But also wanted your thoughts on the precious metal market because of the several deals that are being signed by US with several other countries. Safe haven demand has been receding and oil is off from the highest that we saw in the last few months. Where do you see the precious metal market headed, both gold as well as silver?
I think the big news for the precious metals right now is US has deployed two of its nuclear submarine near Russian waters. So I think it's a big escalation as far as the geopolitics is concerned. So we've seen at the times when there was a possibility of ceasefire between Russia and Ukraine. At that time, gold prices have come down quite sharply. But now it's the completely opposite scenario. We've seen the action which US took as far as keeping their submarine near Russian waters. Russia foreign minister was quite aggressive in its tone, and they said that they are not going to tolerate this, and they have enough of capability. They even went on to say that this is nearly, similar scenario to the World War and all. So all these escalations will continue to support bullion prices and gold prices also. So I think there is a possibility where gold prices can go up by another 40 $50 on MCX. That should translate into 1 lakh 3,000, 1 lakh 3,500. Beyond that, we need more triggers. But I think this is not the time. In this kind of scenario, we should not aggressively shorting gold. That's not a good idea. So if there is a ceasefire between Russia and Ukraine, then it's a different story. But that doesn't seem to be the case right now. And hence, I would recommend you to go long in gold around 99,800, 1 lakh rupees, and can see another upside of 1 lakh 3,000 or 1 lakh 3,200. So buy the dips in gold also.
Buy the dip in gold, that's the word coming in. What about silver then? Is silver likely to outperform gold in the short term?
So silver last week had underperformed because of the what we saw in the comics copper. Comics copper prices went down by 22%, and that had led to liquidation in most of the PGMs and including silver. So if you look at the outlook of the China's economic outlook, that doesn't seems to be portraying great picture. But at the same time, if you see what is happening on the silver supply side, it's looking quite bullish. So whenever I see that the supply side is weakening and the demand is stable or growing, at that time I will take a long call, which is the case with silver. 1 lakh 11,000 good levels to go long. 1 lakh 15,000 should be your target, and 1 lakh 8,000 should be your stop loss.
Okay, so that's the outlook when it comes to gold and silver, but we haven't seen any kind of macro data come in from China as well. Your thoughts on where the Chinese economy is headed and what kind of impact could that have on the industrial metal market globally then?
I think during the weekend I was reading an article which said that the housing prices in China continues to suffer. For the month of July, June and July both, we've seen the sales of new homes have hit a fresh record low, and I believe that that's not very good sign. But if you look at the hindsight, if that is the case, then government may have to take some steps to again, bolstering the sales of houses. So if that takes place, if there is any kind of direct or indirect stimulus, so in that scenario, I would believe that the downside to the industrial metal complex, considering the weakness in dollar, considering the concentrated market of many of the metals is pretty tight. Considering all these factors, the downside is very limited. Copper can go down till 870, 75 maximum. But beyond that, I don't see any major downside.
Okay, so that's as far as industrial metals is concerned. Mr. Shah, thank you so much for taking your
My
time out
pleasure.
and joining us here on ET Now, helping us understand not only industrial metals but also what's happening in the world of oil. Thanks so much for joining us today.